Okay, thank you once more for joining our PPFA class for financial accounting. Today we'll be looking at the topic partnership accounts. We'll be looking at partnership accounts. This is one of the critical topics for the diet, and I will enjoin everyone to please pay rapt attention. This is not a part where you want to joke with at all. So we'll be looking at partnership accounts, like I said earlier. And as usual, if you have any question, please feel free to pause, call my attention to it. We'll take it one after the other. So at the end of this class, we expect that you'll be able to define partnership and state the different types of partners in a partnership. Explain how a partnership is formed. State the contents of partnership agreements and rules applicable. Identify accounts that are peculiar to the partnership business. Be able to prepare partnership accounts under normal situations, and also when there are circumstances that would warrant a change in the structure of the partnership. Make some adjustments, accounting for evaluation of assets and so on, and the accounting entries. So let's deep down into it. This is a loaded course. Hopefully we can complete it today, and if not, we'll extend it to the next class. So let's continue with this. So for partnership, what is partnership? Partnership is the relationship rather that subsists between persons carrying out a business with the view of ensuring that they make profit. It includes a minimum of two persons coming together to actually start a business, to say, let's start a business and let's make profit. So for example, if I and Motunrayo go into form a business together, we'll call that partnership. So it has a minimum of 2 persons and a maximum of 20 persons, except for firms of professionals such as solicitors, accountants, and chartered engineers, surveyors, which are exempted from this rule of maximum of 20. But the minimum for any partnership is 2. So you can't even say the minimum is 1, because you can't be in partnership with yourself. That's just what sole proprietorship, right? So there are different types of partners in a partnership, and this is usually based on their participation in management of the company. Are they involved in the running of the day-to-day activities of the company, or to the extent of the liability that they own? You know, when you say liability that they own, it means that if anything goes wrong, to what extent are they liable to? Remember when we looked at limited liability company, you say what? That whatever happens, their liability is limited to what? To the value of money that they have in the company, to the shares, to the equity that they have in the company. So these types of partners is based on what? Their participation in management and the extent of their liability. Now let's look at the different types that we have. We have the general partner, or what you call the active partner. This partner is the partner that has full power of participating in the conduct of the partnership business and is liable to the full extent of his estate for the partnership debt, hence have unlimited liability. So when you see something you call active partner, in terms of management, the person has full power the conduct of the partnership business, and in terms of liability, the person has unlimited liability. So you see this kind of partners, they will be involved in the day-to-day running of the business, and because of the fact that they're also involved in the day-to-day running of the business, they have unlimited liability. If something happens to the business, apart from paying with, apart from using the business itself to pay back, the debtors can also come, right, for their personal assets, right? So that is where you have, that is what the unlimited liability, that is what it implies. Now let's look at the second one, limited partner. Limited partner is liable for the debts of the partnership only to the amount he or she has agreed to contribute to the business. So if you see this first one, it has unlimited liability. This second one has a limited liability. His extent of liability is capped off at the amount of money that person has agreed to contribute to the business. And this person does not take part. See, he cannot take part in the management of the business. This one takes part in the management of the business, has unlimited liability. This one does not take part in the management of the business and has limited liability. So this is like word and opposite, right? Active partner and limited partner. Let's look at the third one, sleeping or dormant partner. He does not take active part in the management of the partnership business. He only contributes money and shares in the partnership profits. By inference, this partner usually has limited liability. He has limited liability. This one also does not take part. It's like a limited partner, right? He does not take part in the activity of the business in any way, in any form. What his own is just, I contribute money and I share in the profit. He really does not, is not involved at all in the management and also has limited liability. The last one is what we call nominal partner. This partner, this one, he does not even have any equity stake in the business. He has no capital contribution in the partnership, but shares in the profits. So it might be that he's bringing in a technical expertise, right? It might be that he's bringing in something different, but he's not providing any capital in the business. Nonetheless, he's still going to share in the profits of the business. And it's usually based on agreement, right, that they have with such partners. It might be that you are using the person's name, right? For example, almost all these accounting firms that you see in Nigeria, KPMG, you know, it's a global brand, but it's not the global brand that actually owns all the KPMG that you have in the world, right? It might just be that, or Ernst & Young, or PwC, and all those other big firms. So it might just be that, oh, you're saying, can I use your name to establish one in my country? And they say, go ahead, but you will be sharing from the profits that you are making. That will make them what? A nominal partner. One or more partners in partnership may limit their liability, but at least one partner must have unlimited liability. Every partner in a partnership is an agent of the firm and the other partners for the purpose of the business of the partnership. So let's look at what partnership agreement entails. Partnership agreement entails. Don't forget, if you have any question at any point in time, you can always call my attention and I would gladly answer. So what is a partnership agreement? A partnership agreement is just a basic document that sets out the conditions under which the partners will carry on their business. It's also known as the partnership deed. It's also known as the partnership deed. It's an agreement, it's a document where every partner will sign, say, okay, this is what we agree. We'll share the profits in this ratio. You and you will be in terms of management of the company. You will be in this. Whenever we want to make a decision, it will be 50-50. Do you understand? All those details will be involved, will be captured in the agreement. It will include the capital that each person is going to bring. Okay, we want to set up a business. It will involve 10 million naira. Okay, 10 million naira. Partner A, how much are you bringing? Partner B, how much are you bringing? They will state this. It also will involve profit sharing. How their profits, not only their profit alone, this should actually be profit/loss sharing. How their profit will be shared, how their losses will be shared, this will be spelled out in the partnership agreement. So the partnership agreement must contain that. The partnership will also contain whether interest on capital or drawings will be allowed or will be charged. They might say, oh, that capital that I brought from the beginning, you are going to be paying me 8% interest on it, 10% interest on it. The agreement that they have with each partner. Oh, if you take money from the firm as drawings, we are also going to charge you interest. All these things, they will be agreed. If the partners also, whenever they give loans, what is the rate, interest rate that will be payable on any loan advanced by any of the partners? These are some of the things that you would see in a partnership agreement. Whether current accounts are to bear interest, and if so, at what rate. We'll look into details. What is a current account in very, very soon. Partnership account will also, so agreement will also state whether partners' drawings are to be limited in amount to what contains in the current account does not turn into debit. They will also say, oh, if you have 2 million naira in your current account, that's how much you can take. We will not allow you to take more than what you have in your current account. Don't worry about current account. We'll look at it in very, very soon. The different types of accounts that you see in the partnership account. Then whether partners are entitled to remuneration. So, we earlier, when we're looking at the different partners here, we said some of them might be participating in management. So those that are participating in management, are you going to be paying them? If you are going to be paying them, how much are you paying them? Because if I am involved in the running of the business, even though we are partners and you are not involved in the running of the business, normal, I should be taking at least be collecting salary. Let's forget the profit that we are sharing later. I should be collecting salary. So something like that is what you would also consider. Also, you will look at how the books of the accounts will be kept. Let's agree. When is our financial year end? Are we going to be providing audited financials? What are the things that we want to do regarding the books of the business? What is the method of valuation that we want to use? Are we going to be keeping goodwill in case a new partner is going to be joining us, or when an existing partner exits, exit the business, not exist rather, exit the business. If an existing partner exits the business, what is the method that we are going to use for our valuation of our assets? Are we going to use book value, or are we going to revalue the assets to market value so as to get the current net worth of the business? If that's what we want to do, then all these things will be agreed from the get-go. How do we settle our dispute? Are we going to put it to a vote? If it is 2 persons and it's 50-50, what next? How do we settle disputes? What are the procedures for settlement? Then, if we want to admit new partner, I and Motunrayo started the business. If we want to bring in new partner into the business, let's say Caroline, for example, how do we admit Caroline into the business? Must it be that it must be a unanimous decision? Must it be that majority carries the vote? Or must it be that a minimum of maybe 70%? It depends on whatever condition that you have put in. You might also have put in that, oh, the person will pay you some level of goodwill. Or if your market value is 18 million, the person must pay you guys, existing partners, an additional 10% just to join into the partnership. So all these things are what will be contained in the partnership agreement. They will be set from the get-go to be what will guide. That will be the document that will guide the partnership. That will guide the partners on how to carry out their obligations. So in some other instances, you will find out that maybe there are no partnership agreements, or the existing one is silent over a number of vital issues. Then the following rules shall apply. So these rules will only apply where what? Where there's no partnership agreement, one, or yes, there's a partnership agreement, but it was silent. It was silent on some conditions that we need to clarify, right? It's only when it's silence that you now go to apply these rules. Number one, partners shall share profits and losses equally and shall contribute equally to capital. So every partner contributes equally to the capital and will also share profits and losses equally. So I want to set up a business. The business is worth 2 million naira. And we have 3 partners. We share 2 million divided by 3. And everybody will pick what applies to them. What applies to them. Number 2, the firm shall indemnify every partner in respect of payments made and liabilities incurred by him in an ordinary and proper conduct of the business of the firm. It means that as a partner, while doing the business for the partnership, you must reimburse me, right? Every partner must be what? Must be reimbursed. So you won't say, I should be your guy's partner. You don't need to collect your money back. No, you must be what? You must be reimbursed for any amount you spend in the course of the business. Any advance or payment in excess of agreed share of capital will attract an interest at the rate of 5%. Every partner may take part in the management of the firm. Every partner may take part in the management of the firm. Number 5, no partner shall be entitled to remuneration for acting in the firm's business. Number 6, no person shall be introduced as a partner without his consent and the consent of all the existing partners. Without the consent of all existing partners. Partners shall not be entitled to payment of interest on capital before ascertainment of profits of the firm. So you must first of all confirm that, oh, this is the profit that we made, before you can now start saying we want to pay interest on capital. Otherwise, you leave it. Everybody, no interest for you until we confirm the profit that the firm made. The partnership books and accounts shall be kept at the place of the business of the firm or at the principal place of business, and every partner may, when he or she deems fit, have access to inspect and copy any of them. It means that the books of the account, the books of the business is kept in the premises of the business and is also accessible to any of the partner. Not just accessible to them, they can also freely inspect it and copy any of the books. Differences arising from ordinary matters in connection with the partnership may be decided by majority of the partner. So in where your own partnership deed or your partnership agreement is silent on this particular point, the deciding rule will be that this would take over. Majority of the partner, whatever the majority of the partners say, that is what will go. However, no change in the nature of the partnership business may be made without the consent of all existing partners. It was even said here, no person shall be introduced as a partner without his consent and the consent of all existing partners. This one has nothing to do with majority is the one that would make this decision. So you can't change the nature of the partnership business, and by changing the nature, you can say we're doing accounting before, we're a tax firm before. Now we want to be an engineering firm, right? You can't change the nature of the business. All the partners must consent. And if you guys don't want, go and form your another partnership business. So let's look at the related accounts for partners. Related accounts that are for partnership business. Number one, we have the fixed account. Sorry, the fixed capital account. The fixed capital account. And this account records the fixed capital or long-term capital of the partner. And the partner must retain in the business and cannot take out in drawings. You cannot take out in drawings. The balance on this account does not change very often. This balance on this account, it really does not change very often. The only time it will change is when new capital has been put into the business, or maybe when a partner is leaving the partnership, right? Partner is leaving the partnership and they needed to close that particular one and bring in a new one, or they are just closing it and they're maintaining the remaining partners. So that's on fixed capital. Now we have what we call a current account. You've been seeing me mentioning current account since. It's not like your normal savings account and current account. A current account is used to record the accumulated profits of the partner and the partner's drawing. So all the money that all the profit that the partner has been making, his accumulated profit over the while, will be in their current account. And if he has drawn also, he has taken out of the proceeds that he has made, right? All this while, it will be also in the current account. So the first one is a fixed capital, where it's a fixed amount, usually for long term, does not usually change, while the current account can be changing and be changing like the way the sun comes up and goes down every day, right? So you it stores the accumulated profits, right? And it also takes care of drawings of the partnership. Then there's something we have where we call the fluctuating or floating capital account. This is a capital account that not just has the fixed capital account, it also has an element of the current account. So a floating capital account will have the characteristics of both the fixed capital and the current capital. So that meaning that the fluctuating capital account is also the one that owns the fixed capital of the business. It's the same account that they use for accumulated profits, and is the one they use for withdrawal. So that's a fluctuating or floating capital account. We have the loan account. That one is self-explanatory. You collect loan, that's the account, or you give out loans to the business, that's the account for the partners. Now we have what we call the salary account. Salary account is awarded to each partner from the profits, and the residual profit after deduction of notional salaries is then divided between the partners in the agreed profit ratio. So the salary account is the partner that is working for that firm, that is working for the firm, that is involved in the management. It might be collecting a notional salary, and when it's collecting a notional salary, this salary will be given to those that the salary is awarded from the profit, right? And the residual profit after deduction of salary is now then divided. So you have, for example, let me do partner A, B, C. They made 100,000. Okay, well, we have an example to show this. So let me just leave this. They have 100,000. That was the profit for the year. And this from this guy here collects maybe 30,000 from it as salary. So you take it and add it to salary. This guy collects salary, 30,000. It's the 70,000 that is left that you now share between ABC. And when you share this between them, you now have what each other person collects. So this guy A that has collected 30,000 salary before will still collect whatever is left on his own portion, right? And that is what you mean by here, that is the residual profit after you have removed the notional salary that is divided between the partners in the agreed profit sharing ratio. So the drawings account, that one is also simple, straightforward. We have done lots of these in our previous classes. Drawings account, when you withdraw money from the business, and the interest account is the when there is when you pay interest on your long-term capital. And unlike your normal, so now we are saying you are paying interest on your capital account. You gave capital to the business and you're saying, oh, we want to be charging interest. Let me take you guys back a bit. You remember when we were doing the partnership agreement, we said you could also, one of the things you can agree on is what? Your interest on capital, and drawings. So you might say, the capital that I have dropped for this business, right? I want to charge 8% for it. This interest is what we are referring to here. So the account that the partnership will be paying your interest to is the interest account. Nonetheless, this interest that you have charged, you can't call it interest expense. During your normal, you will remove it from as interest expense. You write your gross profit, then from your gross profit, you remove all your operating expenses, you remove interest expense before you get your profit before what? Profit before tax. In this situation, interest that is charged on capital account is a share of the partnership profit. It is from the partnership profit that you now remove this interest. Yeah, you remove if they have paid salary before you now share whatever is left between the partners. Let me take that again. The total profit, if they have removed salary before, you add it back to get the total profit. Before you start sharing the profit to the partners, you must remove the salary that you are paying, the interest that every of the partner has taken. This after you have done this, whatever is left. So using this my example, let's say 30 goes to A. Let's say B, this one is the salary. Then let's say B is interest. B charges interest on his own money. Let's say on his capital account is 20. We'll leave it like this. What is left is 50. Is 50 will now share between A, B, and C based on their agreed sharing ratio. If the agreed sharing ratio, for example, is A is 1, you are 2, and you are 2. We are left with 50. So this guy will collect additional 10, and this guy will collect additional 20 as share of the profit, and this guy will collect 20 as share of the profit. We will look at a focused example very soon. So let's look at guaranteed share of profit. Guaranteed share of profit. Let me quickly take a quick stop here. So far, are there any questions? Am I flowing? Should I continue? Should I slow down? Unmute your mic, give me feedback. Robert, Caroline, Otunrayo.
You can continue, sir.
Okay, so I'm making sense, right? You are following.
Yes.
You can continue, sir.
Okay, thank you. Thank you, guys. So let's look at guaranteed share of profit. When you say guaranteed share of profit, it's there are some times that some partners will say, no, for me to join you guys, I must be guaranteed that my annual or the profit that I'll be earning every year will not be less than 20,000 or 20 million. It depends on what they've sold to the guy. If, for example, they told him, we're trying to set up a partnership business, this, and that. If you join us like this, you will see the amount we'll be making. We'll not be making less than 20 million naira a year. And I say, if you can put it down in writing that I will not make less than 20 million naira in a year as profit, that is now what we call a guaranteed share of the profit. So occasionally there are agreements that a partner will not receive a share of profit that is less than the specified amount annually from the partnership business. If there is a year when the share of profit due to such partner is less than the stated amount, then the deficiency will be borne by the other partners in their profit and loss sharing ratio, or the ratio in which they contribute capital, if that was the initial agreement. So that is guaranteed profit. That is guaranteed profit. We're just saying that, oh boy, join us now. If you see the money you'll be making, and the guy say, okay, if you can put your money where your mouth is, put it in writing that me, I don't know about two of you, out of the three of us, me, Caroline, and Moturayo, say, put it in writing. I will not earn less than this amount. And they put it in writing, right? And you apologies for that. So that is guaranteed share of profits. All this will solve some questions on it. But before that, let's quickly look at accounting entries so that we can now start getting into the groove of solving questions, trying to do some of these things that we have been mentioning since. But the accounting entries are this. If you draw stock for personal use, you took stock of the company for personal use, what you do is you debit the partner's current account. I'm sure by now you guys know the partner's current accounts, capital accounts. They are what? Are they debit balances or credit balances? Oh yeah. Exam is in few days. You cannot. This one is a TS1 question. The partner's current account or capital account, is it a debit balance account or a credit balance account? It's a credit balance account. Thank you. So it's a credit balance account. So when you take money or you take goods from the company for your own personal use, you debit that account. You debit the partner's current account and you credit the trading account. Interest on loan advanced by a partner, you debit the profit and loss account, then you credit the partner's current account. So these things are quite intuitive. Just look at them. I don't think there's anyone that you would actually look at that you are not seeing, that you've not done something similar when you are looking at postings, when you were doing your double entry. The same thing almost applies here. When there's interest on drawings, the person takes money from the business, and not just that, they are going to charge you for taking money from the business, interest on the money that you took from the business. If that was part of the agreement, right, you are going to debit the partner's current account and you credit the statement of distribution of income, because it's an income to the partnership firm. The same thing will be when you are the one earning interest on your capital account, right? You debit the statement of distribution of income, right? And you credit the partner's current account. So if you look at almost everything here, debiting partners' current accounts, you debit drawings, you debit statement of distribution of income, and that's how it is. So the statement of distribution of income shows how partnership profit is to be shared among the partners. So let's look at this example. Let's look at this example. Benga, Harris, and Ibom, they are in a partnership. Benga, Harris, and Ibom are in a partnership. The profit of the partnership for the year is 1,146,000. Benga has contributed 500,000 on fixed capital, Harris 400,000, and Ibom 300,000. The partners have agreed to share profits in the following way. Harris should receive a salary of 50,000 naira and Ibom a salary of 100,000 naira. All three partners should receive interest at 8% on their fixed capital contributed. Residual profit or losses should be shared between Benga, Harris, and Ibom in the ratio 3:1 respectively. Show how the partnership profit should be shared between the partners, right? Show how partnership profits should be shared between the partners. You remember when we said how partnership profits is shared between the partners is what we refer to as what? The statement of the distribution of income. The statement of the distribution of income. So let's bring out our Excel and we start to work this out. We start to work this out. You first of all, what you need to do, you start from the profit of the share of the company. This is the profit of the partnership is this. And we look at the salaries that each one of them make. We remove it, then we start working our way down into how much is left. So let's start. Let me bring out my Excel. Can you see my Excel now? Please confirm now. Are you guys not in this class? I can't hear you.
Yes, sir, we can see you.
Okay, thank you, Motu. Okay. So I'll be referring you to when you want to do your partnership account, you see, profit of the partnership for the year is what? 1,146,000. So let's start from there. Profits this is for what? The Benga, Harris, and Ibom partnership. Benga, Harris, and Ibom partnership. Okay, so profit for the year is 1,146,000 naira. So 1,146,000 naira is the total profit that they made for the year. If you remember, we said that before we start distributing the profit, we will do what? We will, number one, remove what? The salary. We will remove if there's any interest paid on capital. Let me show you why I mentioned it. I said, whenever there's salary here, I take these two. I said you would remove the salary and you would remove interest on capital account. So before we start sharing the profit, let's go back to the question. Benga has contributed this, Aris has done this. The partners have agreed to share profits in the following way. Now, once you do it this way, to make your work easier, have the name of the partners, have them up, so that anything you are sharing, you are just putting it into each person's own immediately. So let's say this is what? Aris. No, Benga is the first person. Benga. You have Aris. And you have what? Who is the next person? Who is the last person? Ibom. Before we start sharing, we said we are going to remove, Aris should receive a salary of 50,000 naira and Ibom should receive a salary of what? 100,000. Aris, let's have here, no, salary for salary of partner's salary. Partner's salary. Partner's salary. How much is it? Aris is 50,000 and Ibom collected how much? 100,000. Sorry, is my background noise disturbing? Do I have to close my windows? Somebody just put on their gem beside my eye. Is it disturbing or am I fine?
It's okay, sir.
Okay. So partner salary is 100,000. So that means we have a total of how much to remove from here?
150,000.
150,000. 150,000. So that's how you'll be working your way down. So let's continue. 150,000. That's what we are going to remove from there. What did the next line tell us? The next line says that all three partners should receive interest at 8% on their fixed capital contributed. Interest on capital contributed. In your notes, you can quickly maybe go down somewhere and quickly calculate for each one, right? Or you can do it even right there, right here, and say capital. But for me, I prefer a neat way. Go to your notes and yeah, you can just do bracket working notes 1. Do you understand? You can come here, write notes and write working notes, or write okay, this one should be working notes. Working notes. Then you write 1. So you can put what's their capital contribution, fixed capital for each person. Fixed capital. Fixed capital. The first person is Benga. Let me just copy it from here so to make it faster. How much is your capital? Benga is how much? 500. Aris is 400,000. And Ibom is 300,000. Please, we have done this before in our other classes. Calculate the interest for each one for me and be calling it out. You guys are almost time for your exams, please. Oh, yeah. Let's do this. So how do you calculate it first? You have to tell me, how do we calculate it? If I want to get interest on this, see, all three partners should receive interest at what? 8% on their fixed capital contributed. How do I calculate the interest? Please tell me.
It's 100 times 500.
I can't hear you. Robert, Motun, Caroline.
8 times the fixed capital divided by 100.
8 times fixed capital divided by 100. Okay. Do we have any dissenting opinion? Okay, so you're saying that I will do it like this: 8% times 500,000. Is that correct?
8%, yes.
Okay. So I'll do that again for the others. I'll just drag it like this. See, it's the same thing. 8% times 400,000. 8% times 300,000. So this is our answer, right? Interest to remove. So we are going to put it for each person. Interest on capital, working note 1. We are going to put it, just link it together, 40,000. But your own, you'll be writing it out. So you just quickly write it out, 40,000, this, and this. So what's the total of this? Can somebody sum it together? Sum it together. I want you guys to be active in the class. As I told you, this is a very critical portion. 96,000. Thank you so much. So we will remove these 2 from this profit. This is the total profit they made, right? We are going to allow for partners' salary to be taken out, this to be taken out, then whatever is left is what they will now share amongst themselves. So let's look at this. We have treated this. And now they said the residual profit. Even see the English they use. They said the residual profit or losses. Let's go here. Our residual profit. Our residual profit will be how much?
900,000.
900,000. Thank you. 900,000. So how do we share this 900,000? That will be what? The next question. How do we share this 900,000? Share of residual profit. We have said our residual profit is what? 900,000. So how do we share 900,000? So what we are going to do is the same names that we have here, write it down on this side in the same, in the same way, Aris and what? E-bomb. When you have it there, what you do, I'm not sure if there are mathematics students among you guys, but you know that when you want to do ratio, the first thing to do is to sum everything together. Do we know this? Do I need to explain in details, or should I just, who does not know how to solve ratio? Robert, you were about to say something.
No, sir.
Okay. Let me close my window. I can hear you guys. Okay. So, but you know how to solve ratios.
Yes, sir.
But Trial, you know how to solve ratios.
Yes, sir.
Okay, thank you. Caroline?
Yes, sir.
Okay, thank you. So it makes the work easier. So we're just going to do, when you're trying to solve ratio, maybe for those watching the videos that do not know, the first thing to do is to add everything together. 3 plus 2 plus 1, that will give us what? 6. And you pick the first ratio. So if they arrange it this way, it means that Benga is 3, Aris is 2, and Ibom is 1. So first thing is to come here and do, this one will be 3/6. Oh, it's showing dates. I need it to not show anything. So I do this. Okay. So 3 divided by 6, right? This one will be 2 divided by 6. And this one will be 1 divided by 6. These figures that we have gotten here is how we will share this 900,000. Benga will take 3/6 of 900,000. Harris will take 2/6 of 900,000, and Ibom will take 1/6 of 900,000. So please press your calculator. Tell me what 3/6 of 900,000 is, and that is what we will put for Benga. What do you say?
450,000.
450,000. Thank you. So you leave. There's nothing for Benga here again. This is for Harris and Ibom. So you go to the next one. Harris is 2/6. What is 2/6 of 900,000? 2/6 of 900,000 is 2 divided by 6 on your calculator. Press equal to times 900,000. Just in case if you do not know before. How much is this, please?
300,000.
300,000. Then we have the last one. What's the last one, please? Just give me the answer.
150.
150. 150,000. 150,000. So now that we have done this, the only other part that is remaining is to add how much each person are taking for their profit share. Profit share. How much did Benga take? Everything. You have to add the partner's salary. You would add the interest that Benga made on his on the capital contributed. You know, it's part of profit. Do you understand? So that is what you would do. So can you sum everything for me? Benga should be 490,000. Please sum Harris for me. Harris should be how much? Are you guys still there? Have I lost you guys?
80,000.
382,000. If we sum all this together, please sum it for me. Do we get 1146? I need to be sure. If we don't get the same amount, then that means we have made mistakes somewhere. Are you summing for me?
1146.
Okay, so 1146. So this is the profit, and this is how it has been shared among the partners. Benga is going on with a very big fat check of 490,000. This is going on, Harris is going home with 382,000, and this is going to 275,000. Can somebody now tell me this share of profits, which account does it go into? Which account does it go into? I'm showing you from the screen now.
Distribution.
I've explained this thing earlier today. Let me go up again in case you cannot find it there. See from here. Which account does this share of profit go into?
Statement of distribution of income.
This statement is what you call distribution of income. This statement is what you call the distribution of income. So this is the statement of the distribution of income. Are you following me?
Yes, sir.
This is what you call the statement of distribution of income, but this is not. This is just a profit and loss statement. In your normal accounts, right? Your final year, after you get your profit for the year, where does it go into? It goes into what? Retained earnings. You debit your income statement and credit what? Your retained earnings. For this particular one, apply the same logic, and I'm even showing you on the screen. Which account will this, each partner's amount, which account will it go into? See it here. It goes into the current account. What did I say current account is? I said the current account is used to record what? Accumulated profits of the partner. Look at it here too. the share of profit will go what? You debit the statement of distribution of income, which I said it's this statement. You debit this statement. For Benga, you will debit 490,000. So what you do is debit 114,600. So the posting will go like this: debit a statement of distribution of income. How much are we debiting? By debiting how much? 1146. We are debiting everything, right? Then we'll now credit all the partner one by one of their respective current account. So you write credit Benga's current account. You credit Benga 490. You do the same thing for Aris. How much is Aris? 382,000. Then 274 for Ibom. All these are credits. That's just the way you do it. Post one debit of 1146 into this, then you distribute it into the different current accounts of the holder, right? So now that we have solved that one, let's look at the second one. So that, because this is the basis, once we're able to understand this, you can go into other subsequent ones. XYZ partnership has 3 partners, X, Y, and Z. The partnership agreement provides for partner X to receive a notional salary of 20,000 and residual profit or losses are shared between X, Y, and Z in the ratio 1:3. In addition, the agreement guarantees a minimum profit share of 32,000 naira to partner Y. The partnership profit for the current year is 80,000 naira. Show how the partnership profit should be shared between the partners. Should be shared between the partners. So let's do this for statement of distribution of income for XYZ partnership. So what did I say? Where do we start from? We have done one already. So if you were listening, then you should be able to help me out here. Where do we start from? Or if you wrote down your note. Oh yeah, now Mutun and Robert, please now.
Profit for the year.
What is it?
The profit for the year of the business. Sorry.
Profit of the year. And we write our partners, right? Over here. Is that correct? What's the profit for the year? What's the profit for the year? See the question now. What's the profit for the year? I can decide to be solving these things for you, but you know, it won't really make sense. So don't take me asking you to participate.
80,000.
80,000, please participate, please. 80,000. So what next after this? What do we do next?
The partner salary.
Okay, so we do the salary. Partners salary. How much is the partner salary?
20,000.
Partner X receives a notional salary of 20,000. So it's only X that will give 20,000, right?
Yes.
Or is there another person that collects salary? So we are going to adjust that one here. So 20,000. Summation of everything here, 20,000. So what is next?
Interest.
That's all, right? They didn't mention anything
No
on
interest.
interest.
Yeah.
What is it?
I said there is no interest there.
Yes, there's no interest. There's no interest there. So now that we have done this, our residual profit will be, how much will our residual profit be? Will it be 100,000? What will our residual profit be?
60,000.
60,000. Thank you. We're going to remove it from this. We are removing this from this. So 60,000. So what is our next item? What are we supposed to do? We're supposed to do what? The share of the profit. The share of the profit. So you can see I'm intentionally showing you guys so that you see that it's the same approach. Share of the profit. We still have our XYZ here. Then what's our ratio? 1, 2, 3. 1, 2, 3. Meaning that we'll have X here, Y here, and Z here. This guy here will be what? 1/6. Sorry. 1/6. This guy here will be what? 2 divided by 6. And this guy here will be 3 divided by 6. If you don't understand how I got it, please let me know now. I don't understand how you got this. Okay, you guys are super, super excellent. So if this is 1/6, what will be the share of profit for X?
10,000.
Motunaya, why is your mic so low this night?
I'm using my phone, that is why.
Okay, I can hardly hear you. What did you say? X will be what?
10,000.
10,000. Thank you. Y will be what? Robert
20,000.
Motun.
20,000. 20,000.
20,000.
20,000. Thank you. And Z will be how much?
90,000.
90.
30,000.
Okay, it's 30,000. So by the time you add all these three together, you see that it gives you 60. 30 plus 20 plus 10, right? So what do we do next? I'm listening, guys. What do we do next? Let me show you again. What did we do here?
We add it together.
We will add it together, meaning from up, we'll add everything together. We'll add everything together. By the time we add everything together, look at the condition in that conversation. So you can see that this sums up to what? To 80,000. Can you see? So it's equal to 80,000. Just to show that we are what? We are working in the right path. It sums up to 80,000. But let's go back to the question. In addition, the agreement guarantees a minimum profit share of 32,000 naira to partner Y. Is that not correct? The partnership profit share, profit for the current year is stated. They said partner Y will get what? Partner Y will get what? 20,000. Yes, minimum. How much did partner Y get here?
20,000.
20,000. 20,000. Can somebody tell me how we will proceed? It means that without even starting any query, it means that this guy must have 32,000 naira here. While we will now find out what we'll do for these other guys, right?
Yes.
That's X and Y. Can you just guess, how do we think that we'll proceed with this?
We subtract
Remember,
it from X and Z.
so how much will you subtract from X? How much will you subtract from Z? Let me give you guys a review from when I did guaranteed share of profit.
They will share it equally.
Share it equally. Did you just say that? After I took my time to explain this, see, then the deficiency will be borne by the other partners in their profit and what? And loss sharing ratio. So now, what's this guy's deficiency? How much is it?
12,000.
So let's do it like this. Deficiency.
So you wrote 20,000.
Huh?
Instead of 32,000, you wrote 320.
Okay, I wrote 320. I'm even going to remove it. So it's supposed to be 32,000. This guy is supposed to have 22,000, and he has how much?
20,000.
20,000. So what's the deficiency? How much is it?
12,000.
12,000. Thank you. So meaning that we have to add 12,000 naira to this guy. And if we are adding 12,000 naira to this guy, that means we are removing a total of 12,000 naira from this guy and this guy. Correct? Am I correct?
Yes, sir.
It means that X must pay a portion of the 12,000, while Z must also pay a portion of what? The 12,000 naira. Now, in this place, I said that they will be what? It will be borne by the other partners in their profit and loss ratio. What is the ratio for X?
1/6.
1/, no, is 1. Don't take the 1/6. You know, it's because this guy is there. That's why it's 1/6. Look at the ratio in the question. Hold on, let me go back to the question. Look at the ratio in the question. X is what? 1. Z is what? 3. So the ratio that remains will be what? 1 dot, see my 3. Is this correct? I want to be sure you guys understand this part. Let me erase this my nonsense. So this will be what? 1 will be left, and I will have dot. I have another dot, and I will be what? 3. Because 2 is no longer, is not sharing in the loss.
Yes, sir.
Do you guys understand? I want to be sure you understand.
Yes,
so,
sir.
to cure this deficiency, it will be for X and what? And Z. This, our ratio here will be what? Can somebody just guess? X will be what? 1 over what?
1/4.
Thank you. God bless you. 1/4. While this other guy will be what? 3/4. It means that this guy will pay, you are earning the larger part of the profit, meaning that you also pay what? The larger part of the losses. So can somebody calculate 12,000 naira?
3,000.
3,000. So it will be a debit. So we are removing from what they have. So I'm putting 3,000 here, right? Then this one will also be, can you calculate 3/4 of Z?
9,000.
9,000. Can you see? So if you sum all these guys together, can you see? It gives us 0. It's just that we are removing 3,000 from this guy. We're adding 12,000 to this guy to make sure he gets his minimum amount of what? 32,000. And we're removing 9,000 from this guy. So our final share of profit, let's sum it together. You know, we have summed it up to this place before. So what we are doing is we are just summing from here down. So 30,000 minus 27,000.
27,000.
30,000 minus 3,000, 27,000. Oh, sorry, I'm not supposed to put it here. I'm supposed to put it down here. 27,000. This guy will be 32,000. That's 20,000 plus 12,000. While our final guy here will be 30,000 minus 9,000. Please, do you understand what we just did?
Yes, sir.
Okay, thank you. So whenever you have, let's just say this question was that the minimum of this guy is 18,000. Let's just assume that the question says partner Y will have a minimum profit share of 18,000. Can somebody tell me, are we going to do this other leg?
No.
No, because he got 20,000 naira already. Is that correct?
Yes, sir.
So thank you. Can you guys attempt this question on your own? Look at it. Look at it. I have faith in you that you can, but just look at it. Okay, so let's look at it together.
Okay.
So we are to provide what? First of all, prepare the what? Income statement. Once we are done with the income statement, we'd also do what?
Partner's current account.
Distribution of the account. Then we'll do the current accounts of the partners. We'll do the current accounts. Me, Bra Zotu started a partnership on the. Can you guys hear me? I'm getting a notification that my network is unstable. Okay. Okay, thank you. Zumi, Bra, and Zotu started a partnership on the 14th of January 2015, sharing profits and losses in the ratio 2:1. The partners agreed that partners' capital accounts and drawings were to attract interest, meaning that the money you have in your capital accounts, you would attract interest, and if you also draw, you also pay interest. The trial balance of the partners as at 30 September 2020, after the preparation of the profit and loss for the period, were as follows. So this is the trial balance. You can see it's balanced, 550 here, and you have 550 here. Additional information. The following have not been taken into consideration before preparing the trial balance. The following have not been considered for preparing the trial balance. Goods taken for personal use by Zumi was 7,000 and Bra was 3,500. General expenses paid by Bra personally was 2,250. You remember when we looked at all this earlier? When we looked at if you take personal goods, you remember? If you take personal goods, I told you where you to be taking. I said all this, that's where we now use all this information. You paid general expenses when we looked at the conditions of a business. I said, if you pay general expenses by yourself, it is expected that you will be reimbursed, if you remember. So Zotu received 4,500 naira as salary from the partnership. Cash drawings were as follows. Interest on drawings were this, and interest on Zotu is this. Interest on capital is charged at the rate of 5%. The profit and loss, you are required to prepare the profit and loss and the statement of the distribution of income. So first of all, we'll do the profit and loss. You know, in this question, they gave us profit and loss account to be what? 51,000. But they said they've prepared this one, and it was after that they've not taken into all these adjustments, right? So we're going to prepare the correct profit and loss and apply those adjustments. So if we are to prepare profit and loss, where do we start from? We start from the balance, from the trial balance. It has been prepared before, and we start from there. So let's start zooming. What's the second one? Bra and Zotu. Zooming, Bra and Zotu partnership. Statement of profit or loss. Balance as per trial balance. Let's put that here. So what is the balance as per trial balance? 51,000. 51,000. So what we are going to do now is look through this question, look out for information that is supposed to have been adjusted as part of what? As part of your income statement. As part of your income statement. So we'll look at them, then we would adjust it to get our final figure. So usually what you would see from this question, let's look through them. Who's taking for personal use? 7,000. By Zumi took 7,000 and Bra took what? 3,500. You remember when we looked at this? Say goods, drawing of stocks for personal use. You do what? You debit the partner's current account and you credit the trading account. By crediting the trading account, it's like you are crediting the sales account. The sales account is going to increase. So because they didn't record this before, it means that what? We are supposed to add this entry to increase what? Our profit and loss. Do you agree or do you disagree? Does anybody disagree? Okay, you don't understand. Thank you. Okay. Zumi is one of the partner. Are you there?
Yes, sir.
So Zumi is one of the partner. Zumi took goods for himself, for his personal use. Let me put it this way. Myself, yourself, and Motun, we are running a business. You now took goods worth 7,000 naira. Do you understand now?
Yes,
we would debit your own account, right? And credit the business for the 7,000 naira. Do you agree with that logic?
so why are we crediting the business?
Eh?
Why are we crediting the business?
Where are we crediting the money to?
Why are we crediting the business?
Why are we crediting the business?
Yes.
Because only one partner took 7,000 for his personal use. What happens to the other partners? Are they not supposed to be compensated? Do you understand?
Yes.
See, they have 3 people running the business, Zumi, Bra, and Zotu. Zumi took 7,000, Bra took 3,500. Is it not just proper that everybody pays for whatever they take? Do you agree that?
Yes, sir.
So if everybody is paying for whatever they take, you take it, even if they did not pay cash, you take it from their capital account that they have with you. You know, we said the capital account is the one that fluctuates up and down, right? It is what? It is the accumulation of the retained profits. So debit his account. You are not going to pay him. So if his retained profit in the business before was 200 million, remove the 700,000 from the 200 million and credit your sales. So they took goods, right? And if they have credited this 7,000 naira to this profit and loss before, it would have increased, right? So you have add goods taken by partners. We have zooming. We have bra. So zooming will be 7,000. 7,000. And bra is how much? 3,500. The addition of these two is 10,500. So we have done the first part. It's from their current account that we would debit them from. Do you understand? Now let's look at the second part. General expenses. I want to take you a little bit back up, trying to see where it was noted before under partnership agreement. I'm coming. Every partner, no matter this, no matter. We looked at it earlier when I said something about you will be reimbursed, right? So you can go through it again, right? Partner shall profit losses, the firm shall identify every partner in respect of the payments and liabilities incurred by him or her in the ordinary course of business. In the ordinary course of business. So I explained that when I was explaining earlier. See, bra paid general expenses from his pocket personally was 2,250. Do you understand? He paid from his pocket general expenses of 2,250. So he has to be reimbursed. And for him to be reimbursed, it will imply these general expenses, normal, if you had not paid it himself, you will have debited the income statement account, right? Are you guys with me?
Yes, sir.
Am I losing you guys?
No.
Okay. If Bra had not paid it directly from his own pocket, the business will have paid for the general expenses. So it will be what? It will be a debit. That will have actually reduced this amount if it was factored in from the get-go. So that is a debit minus 2,500 because he paid it himself from his personal account. If we want to do double entry, right? Let me see. See it here. Payment of expenses of the firm from what? Personal resources. You debit what? The profit and loss account, and you credit what? The partner's account. Am I with you guys? It's the same approach that you use for your normal income statement. It's just that because we are making adjustments here. If we start saying let's post everything ledger by ledger again, it will take us a long time because we're in ATS2 now. You already have an idea of all these things. So let's continue reading. Zotu received 4,500 naira as salary from the partnership. He received 4,500 naira as salary from the partnership. You know, we said it earlier. You remember when we were doing these ones? We said it will not be removed from the profit of the year, but it will be removed before what? We distribute the income. Do you remember when I said it? It will not be removed from the profit of the year, but before you distribute the income, the profit for the year to all the others, that is when you remove the partner's salary. And we did that when we're doing this statement of the distribution of income. That is when you removed the partner's salary. That is when you remove interest on capital. So let's go back. Interest on capital. Now let's go back. So this one, we'll treat it later. Cash made were as follows. Cash drawings. These were drawings. So you'll be taking it from the capital account. You'll be taking it from the capital account. Then interest on drawings were this. These ones to go into the capital account. Interest on loan that we gave to Zotu. This one is interest on loan that Zotu gave to us. Interest on loan that Zotu gave to us. So Zotu gave us a loan and we are paying 3,000 naira. See, loan by Zotu. Can you see it here? It's a credit balance. If it was a debit balance, it would be what? Are we the ones that gave Zotu loan or Zotu gave us loan? If it was a debit balance. Eh?
Zotu gave us loan.
Zotu will have been the one to give us loan if it was what? A debit balance, because debit balances are kind of what? Assets. It will have been an asset. So this interest that on loan by Zotu, if we are going to collect the loan from the bank, will it not be part of our normal expenses? So that will have been, yeah, interest expenses. Interest expenses. Interest expenses is what? Minus 3,000. Minus 3,000. And this is what we will now have as our what? Let me see. Do we have any other thing? Interest on capital account is charged at the rate of 5%. That's the last thing. Remember when we did this, we said interest on capital, it will not be removed from the profit for the year, but before we distribute, right? Before we distribute our profit for the year, that is when we will note it and we will transfer it to each of the partners that are enjoying that. And it is now the residual profit that we will now distribute. So the profit for the year will still be the profit for the year. And it's only the sharing formula that it affects. Do you understand? So all the other things that you will normally do in your normal accounting, you will still do year. So profit for the year. So this will be the adjusted profits. It should be adjusted profit because we have done it again. So our profit for the year will be this. Can somebody sum it? Let me see if my summation and your own is working together. 56,000. Can you confirm that you also got 56,000? Are we good to go? Are we good to go? We have a lot to cover. We have not gotten to change of partnership structures. Maybe I've solved too much examples today. So we have done this. We have treated this one. We have treated this one. So this 3,000 is here, and I've explained this interest on loan given to us by Zotu. How did we know it was given to us by Zotu? Zotu, loan by Zotu in the trial balance is a credit balance, which means what? It's a liability to the organization. So it's interest. So we have to take this as part of expenses. This one we'll treat it later when we are doing this part, the statement of the distribution of incomes. We'll treat that later. This 2,250 had been taken off, right? I wrote 2005. Sorry, let's adjust it. 2,250. 2,250. 2,250. Then goods taken by the partners for their personal use. It will go into the income statement, and I showed you the posting here. See, drawing of stocks for personal use. You debit the partner's current account, and it's going into the trading account. And trading account is the sales account. So sales account, it will increase the amount that you're supposed to receive. And once it increases, you are supposed to, instead of 51,000, you'll have increased it to 10,500. Then the expenses, payment of expenses, see it here. You debit the profit and loss account, right? And you credit the current account. You have debited the profit and loss account. We will credit the current account when we are doing the capital account part leg of the transactions, right? That's when we'll do and we'll treat that part. Interest expenses, I've also shown you how to do that one, and I've explained that. So let's continue. So this question, I actually put it here so that we can, these three questions, we can use it to solve the statement of distribution of income, use it to check the postings and the correction and the others. So this is our profit for the year. This is our profit for the year. So the next thing we are going to do is to do this part. You know, from all the other questions we've been solving, they've been giving us what? Profit for the year. And we just start from here and we work our way down. So this exact same part, this is what we are going to do when we get here. So this is our statement of distribution of income. Statement of distribution of income. Statement of the distribution of income. So we are going to start with net profit. Then we'll work our way down. So let's start with net profit. Profit for the year. $56,250. What are the different partners again? What's this 221? This is Zumi, Bra, and Zot. Zumi, Bra, and Zotu. Are you guys with me?
Yes, sir.
Okay, so Zumi, Bra, and Zotu. That's how we start from here. So we'll pick this, we'll pick the accounts one by one. So was there a payment of salary? Partners salary. Who collected salary here?
Zotu.
Where is it?
C.
Okay, Zotu received 4,000 naira as partnership. Zotu. 4,5. So we write 4,5 here. Okay. Do we have interest on capital accounts? Do we have interest on capital accounts? See, interest on capital account is charged at 5%. Interest on capital account. So interest on capital account. We can quickly do a small note here and call working notes. Working notes. One. Zooming. One. We've done something like this earlier, right?
Yes.
Zumi, Bra, and Zotu. Zumi, Bra, and Zotu. Yes. What's their capital accounts? See their capital accounts there. Capital account, Zumi, Bra, and Zotu. 150. Can you see it here from the trial balance? Can you see where I'm circling on trial balance?
Yes, sir.
How much interest are we paying on each one of them? So let's even just write it out. 150,000, 135,000, 120,000. We are charging them at the rate of what? 5%. Oh yeah, please tell me what the interest is for each person. I'm listening to you guys now. You must know how to calculate the interest.
500.
What do you say? Say that again.
7,500.
7,500. Tell me the next one.
6,750.
6,750. The next one.
6,000 naira.
6,000. Let's see. Okay, correct. You sabi this thing, no be small. So let's move it up here. Interest on capital. Oh, sorry. 7,005 and this. The total of everything is how much? The total of everything is how much? Oh yeah, now. Be active, participate. Remember what we have been doing, right? We'll put the total here. Or is that not how we have been doing it?
It is.
You guys want to leave me alone now?
No,
Or
sir.
is it correct?
Yes, sir.
Am I correct? 7,500 plus 6,750 plus 6,000.
20,250.
20,250. So we have done this. We have done this. Okay, let's start from the beginning. We have done this. General expenses paid by Bra personally was this. We have used this earlier. We have used this. Zotu received partner, you are doing this. Cash drawings were as follows. This one will go to the capital account, right? But what about the interest on drawings? The interest on drawings, is that not an additional income for the firm? It's an additional income for the firm, right?
Yes, sir.
So these ones we are removing, this 450, this we are removing. So those that took money out, they will pay interest on whatever they have removed out, right? To the firm, so that all the partners can do what? Can share from it. I'm trying to use a simple English that I can use to explain it. So let's say all of us, we have one bucket. Me, I decided not to remove money from the firm. Robert and Motunrayo, they were just removing money throughout the year, The interest that they pay, I'm going to partake from it now, right? Interest on drawings. So this one was actually going to be a positive. So let me put this one negative so that we don't mix it up. I don't want us to make mistake. That's why I want to change it to negative. Because this one is interest on drawings. So let's do the interest on drawings. Interest on drawings is 1,000 for Zooming, right? 1,000 for Zooming. How much for the rest?
550 for
1,000 for Zooming. So in this other side here, it will be a negative for Zooming because Zooming paid it. 550 minus 550 Then this one is 450. Then yeah, what is the total of all this? That's 2,000 naira, right? So this one will be like an addition because we're adding it back. So if you look at all these other ones that we add here, we're always removing it from this side. Do you understand? So this template are still not, I've not confused you with this, right? Have I confused you guys?
Yes.
I've confused you.
Yes, sir.
You guys should talk now. I will explain again, oh, please.
Please explain again.
Okay, thank you.
This is just a drawing interest. Why is it there?
What do you say?
I said this interest of drawing. We are adding
The
it at
interest on drawings. So we
Yes.
should have actually added that interest on drawings from the beginning. Are you with me?
Yes, sir.
The interest on drawings should have actually been added just immediately after this. So this is the, let me bring it here. Let me bring it here. I didn't notice it on time, but it's never too late. So as to make it a bit clearer. So this is the profit the business made from their normal business operation, right? 56,250 and 250. But they also said they want to charge people interest. Those that withdraw money from their capital account, they will charge them interest for the year, right? But you know this money that they are charging the partners themselves, and this profit will be shared among the partners.
Yes.
Do you agree with this or not?
Yes, sir.
Okay. So meaning that the total money to be shared is how much now? 58,200. Do we agree up to this point?
Yes, sir.
Okay. So now let's go back to our normal adjustments that we have been doing. So let me leave this one like this. Partner's salary. We usually remove it, right, before we do the distribution of the residual profits.
Yes,
Look
sir.
at it from here. It's just that we've always left it in positive. That's why when I was doing this one the other time, I was asking you guys that, is it going to be, you remember when I asked that question that I said, is it going to be 100 or is it going to be 60? And you said it's going to be 60. You remember that even though we add this to this point, right, we actually remove the figure from this side. So this one can as well be minus. Do you understand my point?
Yes, sir.
So even though it's 4,500 here, it's a negative here, because we are going to remove it from this 58,000 to get our what? Our residual profits. So we have done for this one. Interest on capital account. We said 7,500 plus 6,750 and this one. Is it clear up to this point? Should I continue? I've moved this one up, so let me remove it here. It's what we have been doing before now. That's the reason why I actually gave some examples on statement of distribution of income before I brought in this question. Should I continue? Do we get it up to this point? The only thing that has changed from what we have been doing before is this interest on drawings. And I've explained it to you that 3 of us, we said, nobody should withdraw. Let's use our money for business. If you withdraw, you are going to pay penalty. This penalty will still be shared between all of us. Do you understand?
Yes, sir.
Okay, so it's only this interest on drawings that has changed. And once we added the interest on drawing up to 58,000, yeah, we did what? We continued with our sharing formula. So let's continue. Partner salary will be removed, right?
Yes, sir.
Interest on capital that was paid for everybody. We paid this guy 7,500, we paid this one 6,500, we paid this one 6,500. By the time you add everything together, you told me that it's 20,250. It will be removed. I only put minus here so that you know that it will be removed. So what is our residual profit now?
83,500.
33,500. This is now what we are going to share. Do you agree up to this space so that I can continue?
Yes, sir.
Okay, thank you. So what is the ratio that we are going to use? I'm listening on.
2:1. 2:1.
2:1. Okay, thank you. The first person will be 2, this other guy will be 2, and this other guy will be 1, right? So meaning that we are going to write Zumi first. Is in that order, right? Bra second, and Zotu as the last person. So these two will be divided by what?
5.
By 5, because if we add 2 plus 2 plus 1, it will give us 5. Thank you, guys. To make those that are watching the video, you make it so much easier for them to understand. So divided by 5. So can you give me the figure for zooming?
13,400.
Take that again.
13,400.
13,400. This one will be the same, 13,400, because it's 2/5, 2/5. Then the last guy will be how much?
6,700.
6,700. Thank you so much, guys. So this is the amount that they would have. This is their share of profit. So their share of profit will now be how much now? Let's sum it together. Can somebody sum it? When you sum it together, what did you get? I've summed mine down. I just want you to sum your own. See, I've summed mine. What did you get, please? Wait, so it's ordinary calculation. No, you guys should not leave me like that now. What's your total share of profit?
Is it individually or totally? Like everything?
No, individually. For
Okay,
each one.
9,900 for zooming. Then
Did you get this?
Yes. It's
okay. So when you sum everything together, what do you now get?
56,250.
56,250. Is it different from what we have up here, profit for the year?
No.
No.
It's not, right?
Yes.
Yeah.
If we don't add this one to it, right, we'll have this 58,250. Do you understand now? So this is our share of that goes to every one of them, because they also paid interest, right, on the drawings that they made. So the final profit that eventually gets to them that will go into their capital account is 19,900 for zooming, 19,600 for bra, and Zoto 16,750. 16,750. So that is their share of profits for the current year after that we have factored in all the other expenses. So we have a lot to cover. There's still changes in structure of partnership. I don't know if we can quickly take the theory part, then we can take the examples and look at the admission of new partners at our next class. So this part, it's a lot of work. We actually need 2 classes to finish this. So we have looked at partnership accounts in a normal ordinary course of business, like if there was no changes, right? But we also know that in a partnership, you can start with two partners, and later down the line, you feel the need to do what? To bring in a new partner or to change the structure of the partnership, right? So a partnership structure may change due to one of the following reasons. Number one is that admission of of new partner. It might change because we started the business with Ayo and Motun, and Robert came along the line, or Caroline came along the line and said, we want to bring in a new partner. It might even be that we actually needed cash. And the fact that we needed cash, or it might not even be that we needed money. It might be that we need the experience that Robert is bringing to the table. And because we need that experience, we might say, oh, let's bring in a new partner. So the structure of the partnership will change. Let me bring out my Excel. So in this one now, we're sharing 2 to 5, 2 to 5, 1 to 5. If we bring in a new partner, what will be the sharing formula? All these things will change, and it will dictate how the new partnership will go. Okay, what happens if there was a death of a partner, or the partner did not even die? He said, well, I'm retiring. I've done work for 60 years of my life. It's time to go out of this business. I can leave it to 2 of you. Let's say Ayo decides to leave the partnership and leaves it for Motun and Robert. How would they continue the partnership? The structure of the partnership will change. How they share profit might also change. So all these things. And another point is the amalgamation of a partnership with another business. Ayo and Motun, they are one partnership. Robert and Caroline, another partnership firm. Now say, let's come together. Let's form one big partnership. When they join together, the structure of the business will change. Nonetheless, these are treated, and the treatment for this amalgamation and everything, retirement, is along the same line. However, there are 2 important issues that we should note that affects changes in structure of partnership. And these are goodwill and revaluation. When there's a change in the structure of a partnership, there are 2 main important issues. Goodwill that the firm has already had, and the evaluation of the assets of the company. Let's look at goodwill. Goodwill is that which enables a business to earn supernormal profits. So you would say, a bank like, let's say, First Bank. People will say, you see our old guys, they will say, I can't use any other bank. It's First Bank I can use because they have been existing since all these years. They have weathered the storm. They cannot crash. That thing that you hear is the goodwill that First Bank has established in the market. It is what is making First Bank to earn what? Supernormal profits. And it is because of what? Reputation or special advantages which the business has engages with the rest of the world. Another firm that enjoys a lot of goodwill is Coca-Cola. Coca-Cola. Some people will tell you that they can't really taste the difference between Coca-Cola and Pepsi. But if you ask them, which one do they want to take? They'll tell you Coca-Cola. Some other people too have for Pepsi, no doubt. Because if you are comparing Pepsi and maybe Biggie, you want to go for Pepsi. Even though Pepsi and Coca-Cola might be more expensive, it's the goodwill that they have established in the market. So if you have a firm and the firm has been delivering good quality job over the years, and the new partner wants to come in and quickly wants to enjoy from the sources that you guys have established over the years, you will tell him that, no, you might look at the assets that we have, right? But there's something else that you are not considering, the goodwill that we already enjoy in the market. It is defined as the difference between the value of the business as a whole and the aggregate fair value of a separable net asset. That is how you calculate goodwill. The value of the business, minus the fair value of its net assets. The value of the business minus the value of its net asset. That's how you get goodwill. A goodwill a firm has made may be due to the following reason: superior management skills in top management, possession of efficient and dedicated employees. You know, I said they've delivered value over the years, and people already know them to say, that firm, it will give you something. And that is the reason why they are making what? Super normal profit. So you say goodwill is an intangible asset that a company has. You can't hold it. You can't hold it physically. But goodwill is an asset because it's a goodwill that makes the profit, that makes the business continue to earn supernormal profits. Advantages or strategic location of the firm, it might be that's a goodwill. You might just be located in one strategic location such that anybody that is coming from anywhere, they will just see you. And that is the reason why you're making supernormal profits. It might be the nature of the firm's services or product. It might be that you possess a powerful trademark or patent, and that's the reason why you're making those profits, right? But by the time we value your business as a whole, it must be greater than your net asset, and the difference is what we call goodwill. Like I said, goodwill is an intangible asset. Where it is internally generated, it is not recorded in the books. So you cannot say, I want to add goodwill to my book, Ayo and Daily Enterprises. I have looked at my firm. Value of my firm is 1.5 billion. After I've looked at my firm, after I've looked at the value of my firm, you might even recruit somebody to even value it for you. And they came back, let me even use a straight figure. They came back with 15 billion. They say the value of your firm is 15 billion. You look at your net assets. What is my net asset? You know, I'm sure you guys know what net asset is. Net asset means what? Asset what? Minus liability. Your equity stake in the business. That's your net asset. Asset what? Minus your total liability. Total asset minus your total liability. That's your net asset. My total net asset is 3 billion. Right? Which is also the same as your equity. Now say, my what? My goodwill is what? 12 billion. Now went into your financial statement. Now went to add 12 billion as your goodwill. No. It is only goodwill that is externally generated that is recorded in the books, meaning that somebody actually paid you for this value. Somebody paid you. Either they paid you the total 50 billion or they paid you a portion of this 15 billion compared to the portion of your net asset, and the difference, that is only when you capture goodwill in your account. Accounting for goodwill, I know we're almost up, but I want to finish this up to this revaluation of assets, then we can take all these examples from next class. So please bear with me, give me extra 10 minutes and we'll round up. So how do we account for goodwill? Number one, if you want to raise a goodwill account, that means that you want to have somebody had paid you, or you have somebody had come into the business and they've paid you more than what the net asset of the firm is, then you want to raise goodwill. Yes, you can keep your goodwill account. What you will do is you will debit your goodwill account. You know, I said it's an asset. And when assets are increasing, do what? You debit them. So you debit your goodwill account and you credit the capital account of the partners in the old firm. In the old firm, because they are the ones that do what? They are the owners of the goodwill. They are the ones that own it. They are the ones, you guy that you just come in, you too, join them to increase the goodwill. When you increase the goodwill, anybody that comes in too, that wants to take over the business with you or wants to join you guys too, will also pay you. And they will, by that time, that person will become a old partner in the firm. And you credit them what? In the existing profit sharing ratio, if you want to maintain the goodwill in the books. In some instances, you don't want to maintain the goodwill in the books. They pay you cash for it, you credit the old partners. So you debit cash instead of debiting the goodwill account, and you credit the old partners in the old profit and loss sharing formula. But there are some times where you need to make adjustment of capital accounts of partner. For example, if the new partner is not to pay cash for goodwill, and goodwill at the same time is not going to be maintained on the account, he's not paying cash directly. He's paying for his own stake in the business, right? He's paying for his own stake in the business. And the business already has a goodwill. It's like two-leg transaction. This first leg, you first of all create a goodwill account, but you can see the crediting of the goodwill as the last leg here to close the account. So just remember that this first step that we did here is the first step here. Debit the goodwill account and credit the capital account of the firm in the old sharing ratio. You will now go a step further. You will now debit the account of the partners in the new firm. This is what? The first one is in the old firm. The second one is what? In the new firm. You debit the capital accounts of the partners in the new firm in the new sharing from profit sharing ratio, and you will credit the goodwill to close the account. So these are now what will be left. The old partners, they will get a share of their goodwill that they have done over the years in their capital accounts. You will also debit the accounts of the new partners using the new sharing ratio. You debit the capital accounts. The balance there that is left, it is what is their share of the goodwill. So the other part is accounting for revaluation of assets. So this usually occurs where a new partner wants to go or a new one wants to join. Before you join, let's look at the value of the asset that we currently have in our books. The assets we currently have in our books, are they undervalued? You know, in accounting, we keep our records as what? Historical cost minus what? Accumulated depreciation to get what? Our net book value. To get our net book value. But we know that the net book value that we have written does not necessarily mean that that is the value of the assets. You bought a house 20 years ago for your building of your office. And over the years, you have been depreciating the asset. Let's say now it's even less than 10 million. Now you want to go out of the business, and somebody wants to now tell you that the business is actually worth 10 million because the net book value of all your total asset is 10 million. But you know that that business is far worth more than that. So that is where the valuation comes in of asset and liability. And when you do the valuation, there are three scenarios that may occur. The assets may increase in value, which means that there is what? There's a capital profit or capital gain. And when this occurs, you need to debit the asset account because the asset is what? Increasing. And when asset is increasing, you do what? You debit it. When asset is increasing, and you credit the difference to the what? To the valuation account. You debit the asset account with the difference of the new value and the previous value, and you credit the valuation account. Another situation is that the asset could actually decrease in value. For example, if you bought a car, brand new car for the firm, and after 2 years, even the net book value might be actually higher than the net realizable value. So by the time you do revaluation, you pick the net realizable value, and that is what you'll be putting on your account. So this implies that there is a capital loss on revaluation, and it is the other way around for this. Instead of credit, you debit the revaluation account, and because the asset is going down, credit the asset account. And number three is that the value might be the market value and the book value might actually be the same. And when they are the same, there's no action that is required. You don't need to debit anything. You don't need to credit anything. But in most revaluation that you will see, this is the option that you will most likely see, that it has increased in value. So please try out this example here. We'll continue from here from our next class. We'll continue from admission of a new partner. As you can see, I have examples there that we can use to solve that. We have retirement or death of a partner. We have amalgamation, and as usual, I have loads of assignments for you guys. So in our next class, we'll quickly finish this part. We'll finish this, our partnership account. Then we'll look at incomplete records, how to finalize incomplete records and how we can post that. Can somebody take a screenshot of this? Take a screenshot of this. Moturayo, Robert, take a screenshot of this. Try this particular example.
Okay, sir.
Try this on your own. By next class, this is where we're going to start from. And we'll be meeting on Thursday. I heard you guys are free on Thursday. Robert, is that fine with you? Thursday, 7 p.m. so that we can round up this our session.
Yes, sir.
And cover up for the class that we missed last week. Okay, so thank you guys. Thank you for sticking by. I always appreciate an engaging class. Thank you so much. I'll see you guys next class.